Hello, everyone, and welcome to this short session on the basics of absorption costing. Now, I wanted to show my webcam just to introduce myself, but unfortunately, the internet is not quick enough. I think everyone is on the internet now with the lockdown going on. So I've decided just to use my computer audio. Even the fancy microphone is not working that well today. So I hope you can see my screen, and I hope you can hear me. If at some stage I lose audio, you can just pop it there in the questions. I see there's hello from someone there. Hi, Louisa. Just to pop in a message there. I can't see. I see the screen or I can't hear you, and then I'll see what I can do. If worst comes to worst, we'll record this and we'll post it on YouTube and send you a link. Hi. Oh, someone says cannot see screen. Oh, okay. There's try something quickly. Can you see the absorption and variable costing slide now? Yes, yes. Just one more yes, then I know it's okay. Okay, so absorption costing. Sorry about that. It's the first time I'm using this setup. Usually we've got a proper studio going. So I just want to chat about the basics of absorption costing today. Now, this is relevant whether you are second year, third year, or even CTA. Even in CTA, I see students struggling with the very basics. So absorption costing is quite important, and you're going to use it for quite a lot. There's principles in absorption and variable costing that applies to other topics as well. And this is a topic that is often lectured quite early in second year, so the first time that you see MAC. So what we're going to chat about today is the what and the why of absorption costing, because any topic, you can only really understand it and know how to do it once you understand what it is about and why it is important for a business. So we're going to chat about that quickly. And then the differences between absorption and variable and variable costing question thereafter will be so much easier, and you'll score so many more marks. Students miss very simple marks because they don't really understand what in this topic is it that is important to understand. Then we'll chat about two topics that so many students struggle with. So over and under allocation of fixed manufacturing overheads and the reconciliation between absorption and variable costing. So with this whole confusion, I missed quite a big bit of introducing myself. I'm Francois Steyn. I'm the management accounting lecturer at Tabaldi. I've been lecturing for many years at various universities since I qualified as a chartered accountant, and I love MAC. MAC is so awesome because once you understand what it's about and once you understand the principles, you don't have to study anymore. Then it's all about reading the question, understanding what they want, and applying the principles that you already understand. So the way you study for it is super important. So let's quickly chat about absorption and variable costing. We see the topic costing. What pops into your mind? Well, what I see immediately is that it's just, oh, I hear the doing that the internet that is slow. So I'm going to try to speak slowly because I know in our meeting earlier, we had a meeting with our team. I also heard the audio cuts out now and then. So please bear with me. Okay, so when I see the topic of absorption costing, I immediately think this is a method to calculate profit and to show the profit either in the financial statements or internally to make decisions. So it's a profit calculation, and there's two ways to calculate this profit. The one is absorption costing, and the one is variable costing, or also referred to as direct costing, or sometimes marginal costing. So it's the same thing. Now, why do we have two? So don't worry about the rest of the lecture and don't write anything down. Just listen. By the International Financial Reporting Standards, and by the Tax Act. So we have to use absorption costing when we show profit in our financial statements and on our tax return. So that's the reason for absorption costing. Variable costing, as you will see later when we look at the format, is to make our life easier as management accountants that make decisions within the company. So let's look at absorption costing first. Okay. Let's go back. I just want to quickly chat about the differences. So okay, the what and the why is a profit calculation. We are required by IFRS to do absorption costing when we show profit, and variable costing is easier. Once memorizing it is much easier. And the other difference is the way we treat fixed manufacturing overheads. Those are the only two differences between the two. So remember those, and then you'll get a much better understanding of what it is. Sorry, I see my audio is still breaking up. I really hope you can follow me. And if you can't, then please bear with me and look out for the email with the recording. Okay, so this is the format of absorption costing. So we start off with sales, because remember it's a profit calculation. And next, we show cost of sales to get to gross profit. So gross profit is not just some word. You have to know the word, and whenever you do absorption costing, you have to show the word gross profit for a mark. And what are all these costs? All these costs are manufacturing costs. You'll see every single manufacturing cost to make those sales are included above the profit line. And then below, we have all our non-manufacturing costs, all of them. So what do we have here? We've got a split. Manufacturing costs above gross profit, non-manufacturing costs below gross profit. And IFRS wants us to show it that way. They want to know what was part of the main manufacturing process to make the cost of sales, what was our gross profit, and then all the admin and other expenses below that. That's the first thing. Next, the way we value inventory. If you look at the box here, this is the cost per unit. And what are the cost elements that we always include in the cost per unit? Direct material, direct labor, and overheads. Those three cost elements pop up each time. That's our manufacturing costs. See, we've got a variable cost, that's direct material. Direct labor is a variable cost. Variable manufacturing overheads is a variable cost. But we also include our fixed manufacturing overheads. And that is why absorption costing is referred to as full cost. It's because we include the fixed manufacturing overheads as well. So the inventory value here will be the units times the full cost. And the same for closing inventory. So just a tip here, be careful for first in, first out, because then your opening inventory will come from the previous period, and it might be different from your opening inventory will be from the previous period's closing inventory, and it will be different from your current period's closing inventory. So just pay attention to first in, first out or weighted average, because it will be integrated within our absorption costing. Okay, now let's look at variable costing. How is this different? You can see overall it looks very similar. I've got a question here. Let's just see. Can I explain the more complex principles we need to understand in CTA? I'll get to that at the end, but in absorption costing, there aren't really that complex principles. The basics are what is super important. The basics are what students lose marks on. In CTA, there's nothing new that comes in except they split the over and under allocation, which doesn't even make sense. So you'll lose at most 1 mark. But the basics are still what you get marks for. And students fail absorption costing questions in CTA because of what I'm going through now. It's because of the easy stuff, not the tricky stuff, really. So, yeah. So please bear with me, but I guarantee you it's usually a lack of understanding of the basics that makes students fail the CTA questions. But as we go along, if I see something that is a trick, I might point that out. So thank you for that. So variable costing, you can see it's the same format. We start with sales. It's the same sales, units, price. Then we have a series of costs to get to contribution. So remember, it's not gross profit. We have contribution. And again, the word is important. You'll get marks for contribution. What is contribution? It's sales less variable costs. And again, it's all variable costs. So we start off with the variable manufacturing costs and then variable non-manufacturing costs. So all variable costs are deducted to get to contribution. And then what is below the contribution line? It's all the other costs, which are fixed costs. So you can see the big difference between the two is the format. It's absorption costing, we split it between manufacturing, non-manufacturing costs. And these are variable costs and fixed costs, variable costs and fixed costs. For variable costing, we split it between variable and fixed costs. And that will include manufacturing and non-manufacturing, and the same year. Why do we have this variable costing method if the IFRS requires us to use absorption costing? Think about cost volume profit analysis, or calculating break even, or relevant costing. For all these management accounting tools, decision-making tools, we need to know which costs are variable and which costs are fixed. So for instance, for break even equals fixed costs, and we can get all the fixed costs there, divided by contribution per unit. So there's our contribution, we divide it by the units, and we get a contribution per unit. For relevant costing, when we make decisions, we know our fixed costs are generally irrelevant because they don't change within the relevant range, but our variable costs are. So our contribution is very important. So variable costing is just so much easier to work with as a management accountant. And another difference then is the way we value the inventory. So the units are the same as absorption costing. It's the same physical units in the storeroom, but we multiply it now by only the variable costs. You can see it's only variable costs, direct material, direct labor, variable manufacturing overheads. So we don't have any fixed costs in there. So this is the variable cost per unit. So you'll see opening and closing inventory will be different. And that is the only reason why the profit will be different from absorption cost. The only reason. Nothing else will make the profit different apart from the fixed manufacturing overheads that's in opening and closing inventory. And that is what we'll show in the reconciliation. Okay, now I have to move on to the over or under allocation, because let's go back to the absorption costing. Let's go through the elements here. Sorry, I'm jumping around a bit, but so we've got opening inventory plus our manufacturing costs, so variable and fixed manufacturing costs, less our closing inventory. But we have this funny thing in here, over or under allocation. And many students struggle with that. So I'm going to explain that next. Very important, what figure do we use for the fixed manufacturing overheads? The fixed manufacturing costs. Do we use the budgeted figure? Do we use the actual figure? So is this budget or actual? It's neither of the two. We use the allocated fixed manufacturing overheads. So let's look at that next. So these terms are super important. Actual, budgeted, and fixed. Actual, budgeted, and allocated fixed manufacturing overheads. Oh yes, I've got the right answer there on my previous question. Which do we use? It's budgeted rate and actual units. Exactly, that's the allocated fixed manufacturing overheads. Thank you for that. So actual, what is that? That's the actual amount from the bank account that was paid. That's the physical expense. That's the actual rent that we paid. The actual maintenance expenses. The actual supervisor salaries. That's the actual expenses. Budgeted is obviously the budgeted. That's what we estimated at the start of the period. So if we draw a timeline, budget would be here and actual would be known only at the end. Now, what is this allocated overheads? Remember, we allocate fixed manufacturing overheads using a predetermined fixed manufacturing overhead allocation rate. Such a long word, but it explains exactly what it is. It's predetermined, so it's at the start of the period. So we use budgeted figures, budgeted cost divided by budgeted units. So in this example, let's look at this. Yeah, we've got actual figures and budgeted figures. So we use budgeted figures to calculate this predetermined rate. So budgeted overheads 5,500 Rand divided by budgeted units or normal capacity, and that will give us 5 Rand per unit. That is our predetermined fixed manufacturing overhead allocation rate. There's many words for that long phrase, but this is our allocation rate. And now we're going to allocate that to our production at the actual units. So in this case, 1,000 units. So times 1,000 equals 5,000 Rand. So that's the answer, 5,000 Rand. So make sure you understand the difference between actual, budgeted, and allocated. I see this so many times, even in CTA, people still get this wrong. They use the budgeted or the actual figures instead of the allocated fixed manufacturing overheads. And that actually messes up some other stuff, like the over and under allocation is completely wrong then, and you lose another 2 marks for that. So that's already 3 marks lost because you didn't understand the difference between actual, budgeted, and allocated. So I'll quickly explain this again. This was maybe a bit messy and quick. So, because this is critical to understand, I'm going to just explain it by doing this example again. So just bear with me. Okay, so we're all happy with what was paid. That's the actual expense. And we want that in the financial statements, and we will have that after the over or under allocation. Then we have budgeted. That was what we thought we're going to spend at the start of the period. So here we have our actual, here we have our budgeted. But now what actually goes into the financials, like in this absorption costing, this line item here, let me just get this line item here is the allocated fixed manufacturing overheads. Now, what is the allocated fixed manufacturing overheads? That's how much we allocate to the actual production. So actual production is 1,000 units. But remember, we use a predetermined rate. I'm not going to write out the whole word again, don't worry. Predetermined rate. Predetermined means before anything happened, so it's budgeted rate. And that is our budgeted 5,500 Rand of costs divided by our budgeted units, Remember, this is predetermined. We calculate this rate right at the start of the period. And that will give us a 5 Rand per unit that we allocate to every product we make. Why do we do this? And this is in IFRS as well, in IAS 2 on inventory. We use this to allocate our fixed costs because we don't know how many units we're going to manufacture. We might manufacture 998 units or 1,012 units. So our fixed cost per unit will fluctuate every time we make another unit. So in order to aid us in calculating the cost per unit, we use a budgeted rate, and then we correct for the mistake at the end with the over or under allocation. So I hope that makes sense. So our allocation is our actual unit times our budgeted rate. So actual units times budgeted rate, 5,000 Rand. Okay, so that is our allocated fixed manufacturing overheads. But now, just look carefully now. We're all accountants and auditors, and we know our actual was 6,000. So how can we have 5,000 in our profit calculation, but our bank account has 6,000 less in it? How do we explain that? That reason we show this over or under allocation. Now just read the words carefully. Over allocation, so we allocated too much. Under allocation, we did not allocate enough. So in this case, we allocated 5,000, but our actuals was 6,000. So is this under allocated or over and allocated? So you can see you don't have to memorize a formula. You must just make sure you understand. So in this case, we under allocated because 5,000 is less than the actuals. So this is an under allocation, and the under allocation is the difference between the allocated and the actual. Never budgeted. We don't bring budgeted in here at all. Budgeted we only use for the rate. That's all we use the budget for. From there on, it's the difference between what we allocated in the absorption costing income statement, less what we should have allocated if we had known how much we're going to spend and how much we're going to make. So can you see, after the under allocation was added, it's an expense, we will end up with the actual. Here they say, if we made more units than budgeted, yes, good question. So what if we made 1,200 units? Let's do this in a different color. Let's just see what happens then. 1,200 units. Oh no, I can see what's going to happen then. It's not going to have over or under. So let's say 1,300 units. So we made way more than what we budgeted for. So this is our actual then, 1,300 units times the predetermined rate of 5 Rand. And that will give us, if I'm correct, I'm going to do this in my head, 6,500 Rand allocated. Remember, this is allocated. Is this over allocated or under allocated? Well, it's more than our actual. So this is over allocated, and it's by 500 Rand. So that means we will reduce our fixed manufacturing overheads in the absorption costing income statement that will currently show at 6,500. We'll reduce that by 500, the over allocation, and we'll end up with the actual. So that's basically what we do with the over or under allocation. We adjust for the allocated fixed overheads to get back down or up to the actuals. Let me just see, there's another question. Sometimes referred to as over or under recovery, exactly the same thing. So over or under allocation, over or under absorption even, over or under recovery, it's exactly the same thing. So that's why there's so many different terms for all of this. And so it's important to understand that. Thank you for that. Yeah, very important. Over or under recovery, it's the same thing. Okay, so let's move on to the reconciliation. So before I do the reconciliation, let's just bring in the cost of sales calculation. Okay. Oh, sorry. Here's a question. Is there a possibility of integrating absorption costing and activity-based costing? Yes, but I don't think it will be a big integration. I can't think, because the reason for that is, if you think of absorption costing, that is what IFRS requires, IFRS. And there's no sense in using activity-based costing to report our profit, because all our units, all our opening and closing inventory will be grouped together in one line item. So remember, activity-based costing just allocates the more accurately between products, but if you add it up together, we will end up with the same value. So I wouldn't worry about that integration. Yeah, if there's something like that, it will only be a small portion. It might only be, but I can't even think of any integration question that I can ask you. But it's good to think like this. You always, when you think of topics, don't think in isolation. It's always a good thing to ask, how can they integrate it? Where does the 1,300 units come from in my previous example? Oh, I just made that up. That was just if actual units were more than the budgeted. So the first example is less now, and for this one it's more, just to show what happens to the overall under allocation. How does over and under allocation affect the production line item with regards to opening and closing stock? Not at all. So our opening and closing stock is not affected by the over and under allocation. And this is important to see. So if we go back, this line item here is our allocated fixed manufacturing overheads. So in our first example, it was 5,000 Rand. But our actual was 6,000. So we added an under allocation of 1,000. So let me just write that out. So we had 5,000 allocated, and we had an under allocation of 1,000. And that gave us a total of 6,000, which is our actual. So you can see it doesn't affect our opening stock. It doesn't affect our closing stock. It is just a way to adjust the allocated, which we do continuously throughout the period, to the actual at the end of the period. It's just a line item at the end of the year where we add or deduct the difference between what it should have been, the actual, and what we currently have allocated throughout the year. I hope that makes sense. Let's see. Okay, so here's a question on first in, first out. I don't think we'll have time for that now, but I think it's a good idea to go and do a question on that. Go and practice a question and see how it affects your absorption costing income statement. Remember, like I said, first in, first out, you have to be careful because your opening inventory will be the prior year's closing inventory. So the cost will be known, it will be given. And the production will be separate from it. It will be new costs. So your closing inventory will be at the new price. Whereas if it's weighted average, again, this will be given, the cost will be given, and the new production costs will be added to the opening inventory and then divided by the units to get to the closing inventory. So go and practice that, the first in, first out, and weighted average for absorption costing. Another question, so do we put the allocated amount and under actual under fixed? I think what you might be asking is, where do we put the under allocation? Now, sometimes they put it below this cost of sales block, but IFRS says we need to take it to cost of sales. There are funny rules there, but for second year and third year, you don't have to know that, only in CTA. So don't worry about that. For now, you just show it in cost of sales. So at the end of the day, your cost of sales will include the actual fixed manufacturing overheads. Okay, let's move on. We're running out of time. I'm already over time a bit. Let's quickly chat about the reconciliation. This is very important. So many students don't understand this. So cost of sales is opening inventory plus production units. These are all in units, less closing inventory, and that will be our sales units or cost of sales units. So if you forget about rand amounts, this is the units that was produced and sold. Now, whenever there's a difference between opening and closing inventory, or a difference between production and sales, it's the same thing, then we will have a difference in the profit. You can see there the profit is not the same. And the only reason, I'm going to write it down if my voice breaks up, the only reason for this, for the profits not being the same is opening stock and closing stock not being equal. The rest is all the same. You'll see in variable costing, our fixed manufacturing overheads is the actual. We always show the actual there. There's no over or under allocation. It's actual. And if you look here, it's also 6,000 because we've got our allocated and we've got our under allocation. So it's 6,000, 6,000. It's the same. And everything else is the same apart from opening inventory. That's not the same. And closing inventory. Oh, closing inventory. That's not the same. So there you can see what the difference is that you need to show in the reconciliation. It's the change or the difference between opening inventory. That difference there is not the same. And that difference there is not the same. Everything else is the same. So in our reconciliation, what is a reconciliation? That's something simple. I remember when I heard the word reconciliation, I never knew what it means. I just memorized it. But a reconciliation means you start with one thing that you know, absorption costing profit. So you can see that comes from here. And you end with something else, variable costing profit. It comes from here. So we're going to reconcile the two. So we start with one and we end with the other one, and we show all that is different between the two. We need to explain what is different between the two. I just got a question here. Okay, so let's move on. So like I said, the only difference is the opening and closing inventory. That's not the same. And what is the difference between opening and closing inventory? Can you remember? Cost per unit for absorption costing is 65 because we include the 5 Rand fixed manufacturing overhead. But for variable costing, it's 60. So we don't have that 5 Rand fixed cost in there. And that's the only difference. It's the 5 Rand included in opening inventory and the 5 Rand included in closing inventory that causes the difference in this profit here. See, 60 Rand, 65, 65, 60. And there's our differences. So let's see. And now think about this. I never memorized this, so it takes me a while to figure it out in my head. But that's what I urge you to do as well. Because if you memorize it, you can so quickly swap it around and then you get the wrong answer. So we'll start with absorption costing. And we're going to first deal with opening inventory. So ask yourself, in absorption costing, what do we include in opening inventory? We include the 5 Rand. We include it at 65 Rand per unit. That's for absorption costing. So that is more than the 60 Rand for variable costing. Now, what does that do to our profit? It increases our cost of sales. In other words, it decreases our profit. So our profit is lower. Absorption costing is lower because we included this 5 Rand. So we have to turn it around now. So to get from absorption costing to variable costing, we have to add the 5 Rand. Why do we add it? Because I said it was already included. We add it not to the inventory value, we add it to profit. Remember, profit is what we reconcile here, profit. So we deducted it from profit, so now we add it back. So that's why this is a positive. And in closing inventory, it's the opposite way, or opposite way. So there we have closing inventory is more in absorption costing, more with the R5. So that means cost of sales is less because we deduct closing inventory. So that means profit is higher. So absorption costing profit is higher because of our closing inventory R5 included in there. So we have to deduct it to get it out. So we remove it from our absorption costing profit because it increased our profit because it was in closing inventory, which is deducted from cost of sales. It sounds very complicated, but once you figure this out, you can never forget it again. And that will give us our variable costing profit. So like more effort to understand something like this, because it's easier to just memorize these 4 things and which way it needs to go. But the problem with Mac is there's so many of these principles that you need to memorize if you don't understand it, that it becomes impossible. But once you understand something, spend that little extra time to understand it, then you'll have it with you forever. And remember, you're going to use absorption costing in 3rd year and in CTA again and in the ITC and in a standard principles in 2nd year already is super important. Last question here. Why are the costs per unit for opening and closing inventory the same when they are from 2 different periods? Well, in this case, I ignored the fact that there might be inflation or first in, first out. I just used the same. In this simple example, I just assumed there's no inflation or changes in the costs. Okay, so before I ask for another question or two, before people start leaving, I know we went over time by 10 minutes. Hopefully next time will be a little bit smoother. I'm going to try to do this again next Monday. We've got a promo code here. You can write this down. I'm not going to show it anywhere. 20, and that is for a 20% discount on any of our Tabaldi courses. And this will expire at the end of April, so to include the next payday. Because we know everyone's struggling now with the lockdown and with possible loss of income and uncertainty, etc. So we want to help where we can. If you can't afford this, join us again for the next webinar. And we don't have a topic yet. I'm going to do something in Mac, either Mac 2601 or 2602. So depending on what I hear from you. So please send us at queries@tabaldi.com. Send us what topics you want us to cover in the next webinar. So you can either send it to queries@tabaldi.com or you can go on Facebook and comment on the post. But go to Tabaldi's Facebook page and comment on the post of this specific webinar, what you want to cover in next week's Mac webinar. Okay, so let's see if there are people that's still going to stay on. Let's see if there's any questions. Where can we get the recording? Okay, I'll email you the link to the recording. We'll have to first process it, and we'll post it on our YouTube channel, and I'll send the link out. Please, can you continue Mac 2601? By all means, please send us a mail at queries@tabaldi.com and tell us which topics of 2601 you want covered. Please do standard costing and variances. I think there's going to be a lot of requests for that. So please send us those queries or those questions and chat to us. We'd love to help. That's what we're here for. Thank you for joining me today, and hopefully I'll see what I can do with the connection next time. I don't know what it will be, but I'm going to try to get the technology to work a little bit better. Thank you for joining me, and thank you for being so active in the questions and for helping me start with the screen and the audio. It was fun, and we'll chat again next week. Please join Yvonne on Wednesday at 1 o'clock. There's a webinar on depreciation. So if you're doing FAC and you are worried about the depreciation calculation, please go and check that one out. At this stage, we don't have any webinars for other topics. We might include a tax one depending on Keith's availability. I think that will be very useful. I'll pass it on. And we first just wanted to test this and see if it works and if anyone actually wants to join it. And the response was immense. There were so many registrations. So thank you for that. Yes, so please ask those questions and we'll see what we can do for next week's Mac webinar. And please join Yvonne on Wednesday. Thank you guys and take care, and please keep studying. I know it's difficult at this stage, but you need to keep focusing while you're studying. Don't worry about anything else. But I understand it's much easier said than done. Cheers, guys, and thank you again.